In this chapter, I want to go through some of the top rules of swing trading and trend following. Now, some of these rules are fairly general, others are a bit more specific. They're going to stand us in good stead throughout the CD series as we work our way through it. So, whilst you could argue I should have put them perhaps at the end of the CDs rather than at the beginning, the reason I wanted us to be aware of them at the beginning is because I think a lot of these top rules help us in coming to a determination on exactly what swing trading is as well. So let's kick off. First rule might sound a bit obvious: limit your losses. Now let me tell you why. With swing trading, because we're looking at relatively short moves in short time frames, it's very easy at the blink of an eye, you miss a day or whatever, for the markets to move against you. And if they move against you, then all your hard work over the last 5 to 6 trades can be easily erased. And therefore we have to have an especial rule about limiting our losses, unlike say buy and hold, where if you're out by a day or two it won't matter because you've held the stock for 10 years or 1 year or whatever. It doesn't seem to matter if you miss it by a day or two. It won't make a big difference to your overall gain or loss. So in this regard, one of the key things we've got to get right with this, with that particular aspect, is that we have to place stops below resistance or support levels, because as I say, we want to ensure that the losses are small, and we will have many of them. We will have many losses. That's the nature of swing trading. That's why we've got to make sure that they're small. And the nature of swing trading is you only get a few big gains because, remember what we said right at the top, most of the gains come from trend following. Trends only happen 20% of the time. 80% of the time the market is doing this. Therefore, you're going to get 70% of the time you're going to get a lot of these false breakouts. Because we're going to get a lot of those, we need to make sure the losses are small. So, for instance, for argument's sake, let's say we got in and got a signal at this point to get into a particular stock. Where would we put a stop loss? Well, we might say where might the price go. If we were wrong, that's where the stop loss should be. You could argue it should be there, or you might argue it's here. What I like to do is look at the recent lows. So it might be a 3-day or a 4-day low, and that's where we put it. That way I know that should the price go below this point, then obviously I'm wrong, that it was going to continue going higher. Because if I was right, it shouldn't have fallen lower. That aside, this is a very important rule. We must limit the losses because most of our gains are going to come from a few big gains, and we must ensure that the majority of losses therefore remain small. The second point in relation to all of this is, again, ensuring that with our system and keeping our losses small, that we know where we're getting signal and why we're getting the signal. And let me give you an example of what I mean. Imagine this is a share price and it's doing this. Stylize it, it's pretty straightforward. Any system which gives us a signal over here for swing trading, and by the way, the reason it's swing is because look, it goes down and up, swinging along. That's too late a signal because the market's only got a little bit to rise before it falls. So we have to ask ourselves, well, what kind of signal do we want? Well, we obviously don't want one which is too late. Okay, so that begs a separate question, which is, do we want one which is here while the market is still falling, one which gets us in here right at the bottom, or one which gets us once it's risen a little bit? Well, let me tell you, after a lot of experimentation and what leading traders will tell you, the problem with something here while the market's still falling is you don't know if the market's going to continue falling. So they say that's not actually a good system, a good point to aim for. Well, what about this point here? Well, yeah, sure, that's the holy grail. You get that with a 20/20 hindsight, i.e. the specific turning point. So again, forget that because it's impossible. So then, by a process of elimination, you're left with this. A point of entry in a system where the market has risen a little bit, and therefore you're hoping it'll continue higher. Yep, so you see it here. Don't want to be at point X for the reason I mentioned, because the market's still falling and it might continue falling and you just can't tell. Over here you want to be at point Y, because the probabilities are such that with point Y compared to point X, there's a greater likelihood it'll continue going higher. Whereas with point X, the odds are not as great that it's about to go and turn up. However, there's only a probability that it will continue going higher for instance, go from Y to Z and onwards into an upward trend as swing traders, not a certainty. And by that I mean occasionally you do get in and it goes up a bit and then drops down. But hopefully this only happens 30% of the time once we're in, and this instead happens 70% of the time. Well, in actual fact, even with our risk and money management rules, we should make money if this happens 50% of the time and this happens 50% of the time. However, let me tell you how we've already saved ourselves some money. By making sure we don't have a system which gets us there or here, that already improves us compared to other people. So, again, one of the top rules we're going to have when we're looking at this is systems which show some degree of price turnaround and breakout, but not signal too late. Simple, but I bet you 99.9% of private investors don't think of it in that way.